Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Welcome, everybody, to another Small Cap Discoveries Zoom call interview. Today, we've got the team from Kidoz. Kidoz trades under the symbol KDOZ or KDOZ for those in the US on the Venture Exchange. Reminder, it's January 8th, 2026. We have Jason Williams and Ryan Luxer. Jason is the CEO. Jason, I'm just going to hand it over to you and tell us all about Kidoz.
Thank you very much, Paul and Trevor. Thanks for having us. Excited to be back. We are here this time to update and get everyone really excited about the track that we're on, which is high growth and profitable. And I'm just going to dig in and really excited for your questions after that. So here we are with Kidoz. Kidoz is an ad tech platform. Kidoz is all about the in-app environment, serving brands and their advertising. And here's a quick rundown of our history. We can see that we kind of kicked off in 19, around under 5 million, and grew that to over 15 million. And then we had a transition phase where we changed our sales strategy, rebuilt our tech, and turned profitable in 2024 year end. And we've just had a powerful 2025, which I'm going to run you through and hopefully get everyone excited about what we're up to, because we are excited ourselves. So Kidoz is an AI and advertising system about advertising within games. Essentially, if you are playing an app and you get an ad, it comes from a system very much like Kidoz. And we have a specialized niche where we operate, and that niche is kid safety. So why mobile gamers? We'll start there. And the reason is because it's a high growth area experiencing brand growth and ad growth across the board. These are the three different key channels of digital advertising, which we're all familiar with. YouTube being the CTV heavyweight, social, TikTok, and Instagram. And you hear a little bit less about in-app advertising, but it's a big area, 81 billion. A lot of that is actually, if you are familiar and do play some games, you will know that you get a lot of ads that are for other games. So the majority of that 81 billion has to do with install revenue, not brand revenue, whereas we focus totally on brand revenue. And so it's a huge segment, more than 3 billion users globally, and high growth. We see it's got the highest area there. And unlike the other areas, CTV and social, it's not dominated by a tech giant who would therefore limit the capacity for innovation. There are big companies there, AppLovin being one of them, which we'll talk about, but they don't dominate the way that YouTube dominates CTV or TikTok and Instagram dominate social. So there are opportunities for innovation, which is where we step in. Why Kidoz? Brands, advertisers, they're looking for performant, brand safe solutions for them to reach customers. And we do so. We've been perfecting this type of advertising over the years, evolving our system and our sales and our operations. And it's going fabulously well. These are industry numbers, not our own, about what you can get from contextual advertising versus behavioral. And so because we have built our system in the kids area, which is kid safe, that also means brand safe. And so these metrics would apply. And those help us to sell into the market and capture big campaigns, which we've been doing so again and again. Brands are buying Kidoz because they trust They trust that we are a brand safe environment, that we're evaluating the different apps that we're advertising in, that we've got what the industry will call supply path optimization. So that means less hops from the money to the user, which means more efficiency, less people taking a tax on that money. And we can do that because we have built our own proprietary system over the years with exceptional engineers. We've grown the company more than 50 individuals now, and really starting to come into stride. Also, an interesting way to look at the market here is to show how it breaks down into the different types of people that you're seeing that you're available to market to. So within the Kidoz brand, which is of course, our leading brand and where we've built the company upon, and still the large majority of our revenues are coming from, is within this kids segment, which is about 30% of app traffic. And that we also have the Prado brand, which is our brand that we've launched for marketing to adults and teens in the general market. And it will cover the rest of the non-kids, we'll call them. But interestingly, a lot of companies that are not using contextual targeting, that are using behavioral targeting, they're only working within that 14%, because that's the small and declining percentage of people who haven't blocked behavioral device level targeting. And so it opens up a lot more environment for us to work with, which is one of the reasons why we're very bullish on this type of marketing and this environment, and believe that over the medium term we will have significant advantages, not only within the kids market where we are already the leader, but also in the all ages market where we continue to invest. Here's the breakout of the two brands. Really, it's the same kind of approach. We're using a brand safe approach, increasing brand awareness and brand value. But within the Prado side, we have the capacity to use more data because that is allowed within the regulations. And we continue to kind of invest and develop and innovate to hunt for the holy grail, which is the ability to truly drive sales for any brand or a particular type of brand. Because if brands see sales coming back, then they double down again and again and again. And so that's kind of what we're hunting for. And this is a case study of one of our great advertising partners. We actually work with McDonald's both in the kids business, which we have for years, but this campaign was run in the Prado business, actually targeting US Hispanic audiences. And some of this data came from the metrics that we actually paid for in this campaign. And the creatives were built in-house by us. And so we can see really good returns here. And we've had a number of repeat bookings from McDonald's, and we continue to work more closely with them and hope to continue to scale up into 2026. But we've seen great growth, and we think that we can replicate this not only with McDonald's, but with other US advertisers, which are the big spenders. These are the three core groups that are helping us to scale up so far. McDonald's we just spoke about. We're seeing them both in kids and adults. Lego being a key partner of ours, and also has great potential. Lego continues to go from strength to strength and is doing many innovative things in the market. And we hope to help them champion that message even further in 2026. And Mattel, an amazing company, has always positioned itself as someone who believes strongly in brand safety and in tight regulatory focus on child safety, and therefore a great partner of Kidoz, and someone that we highly value and is helping us to grow. And we're doing, again, a lot of innovative things. It's about what we're doing today and what we've done yesterday, but it's also about what can be done in the future. And there's a lot of capacity for innovation in what we're doing, which is where we we invest our time and energy in determining what our existing brand partners want, but what also potential ones will want. And this, great list of partners, we've worked with them all. I was focusing on some the key drivers, the ones that are really leaning in, but there's opportunity with hundreds of brands globally. And we use strategies. We have campaigns coming in from markets all over the world, and we use those. They're usually smaller. Most markets outside of the US, the spend is not high, but each campaign has value because we learn, we keep an agency happy, we make a brand happy, and it gives us an opportunity to create a case study and to prove success with a brand, even if it's an international division. And so we use that constantly to pipeline into our US sales team and then communicate to that brand and that agency in a local market. And that is working for us, even though our US sales team is small but growing, and that's an interesting area that we're investing in into 26. One of the key areas that we're doing is putting more US sales folks on the ground who can communicate with those brands and the many others that we're working with to continue to scale up our revenues. And so we can see here we've gone from 14 million in 2024, which we had a profit on, small profit, to 18 million in 2025 with strong gross margins. And we're working hard on both ends, the revenue side and the cost side, to continue this scale up. And we've got a big target there of 25 for 2026. And we know that's aggressive, but we feel that if the partners that we've mapped out with continue to lean in, then that's something we can achieve, and we expect to work towards achieving both that growth and operating leverage, as we have invested considerably in our technology platform, which is 100% proprietary, that we can continue to hold unit costs and grow margin and profit. We're poised for growth. We've got that technology that is built. We have the technology team. We have retained all of our engineers and production people for many years now. We're in the right market, and brands are leaning in. We've got the brands coming in, like I said, from multiple markets. We've also got the growth that I showed you, the 16% within the in-app space. And also, we are continuing to invest in our innovation, which gives us, we have an AI targeting platform that we've built and announced. We've got a creative services group internally, which we continue to develop, that is highly valued by brand teams. We've had exceptional feedback on our full package of service, technology, delivery, targeting, reporting. And really, one of the keys here is that we've learned how to please and service brands and agencies. And it's a unique skill that we've honed over the years. And most oftentimes, groups that have the capability to please brands and agencies do not also own the technology. So it gives us a distinct cost advantage as well. So we're able to pitch at lower numbers because we know that we own the technology. We don't have to put a large sales and agency markup on what we're selling, which brands like, and that's why we're seeing the return. Here is how we engage with a brand and an agency. We try and get that first campaign, then we can show them the full capabilities of the group, and then we can move them up the kind of the value scale to the targeting layer. Then we can sell better engagement or engagement numbers, and then we bring them into the creative group and start offering different types of creative, like I showed you on the McDonald's case. which really starts to lock people in because it's a very unique skill, again, that we have, particularly when it comes to servicing the brands. And it's working, which is wonderful. Here's kind of a quick look at essentially what we're doing. The brands and agencies are coming in, that we're placing them onto the Kidoz and Prado's technology platforms. And there's another slide coming next, which shows it at a deeper level. And then we push that advertising out. And essentially, this is a complicated ad tech type of stack slide. But what we do is we sit in this middle part here, depending on what the deal is. But we usually connect to the DSP, which then pushes through to us and out to the publishers. And the brand money, it basically is coming from the left down to the right. And as we build our technology and grow its capabilities, we're touching into each of these different words on here. We're touching into different analytics tools. We're building different kind of data layers. We're doing all sorts of different things that we're conceiving. And part of our key job is to pick and choose the innovation aspects and the points where we're building and connecting that we think are going to unlock the most revenue. And there's a lot of ways that we can do that. And here are a number of the components that we've built. We've built our inventory at scale. We've built what we call the privacy and COPA shield, which is critical to our success within the kids area, which is a piece of technology that allows it creates safe inventory at all times. So any brand advertising with us can know that they're advertising in safety. And that's why we have those large commitments and great success with companies like Mattel and Lego, because they want that safety. Kite IQ is our AI targeting system that we've built that we continue to roll out. Right now, it targets pre-campaign and allows us to set the targeting, but we're advancing it to do post-campaign analysis and also even starting to integrate regional layer information, which will help once we get to the Prado type of targeting that brands are looking for. And so there's a ton of capabilities here, and we're multi-years in and many millions in, and the system is starting to monetize. But really what we're after is, this isn't the type of strategy that tops out at 20 or 30 or 50 million. My goal and the team's goal, and I think it is well within our capabilities, is to push for 100 million in revenue and well beyond. That's not where we're stopping. There is no stop for this type of strategy, and that is what we're doing. The brand spend in America and globally, and we are a global system, is absolutely enormous, hundreds of billions, and we're after that type of money within this company because this system and our capabilities can be scaled to achieve that. These are a number of different options that we can bring to partners to help to monetize different types of ad formats, different types of demand means the buying channels. There's lots of different ways that we can slice and dice our offering, and we're very good at it, and we're getting better each time we bring on another sales, and each time we have another year of investment in our engineering. It gives us more to work with, and we're very excited about that heading into 26. These are some of the technology moats. Really, we're starting to pull far away from our competitors within the kids niche, and many of the buyers know that. It takes some time really for the knowledge to roll out from the buyers about whose technology is the real deal, but we're definitely becoming more and more known within the community in the kids world for being the established leader. And within Prado, we're earlier in that journey, but it will be quicker as we continue to invest and add, because there are very few groups with the depth of this technology who are focusing on brands. Most are focusing on that enormous amount of money, which is in the install space, which includes AppLovin. And so AppLovin is an incredible company, an enormous company, many billions in revenue and an enormous market valuation. And they're here because they work almost in parallel. They're much further along in terms of their engineering. But when you think about a group like AppLovin, and when a group is earning, multi-billions in revenue within a particular vertical, which is in the install space, then, they're a bit hesitant to change what they're doing to start servicing brands. And so our core real difference here is that we have a brand focus and they have an install focus. And so there's a difference in what you're attempting to do and the capabilities that you're developing. There are similarities in the way that the technology works and the different components that we're building. But we have leadership in a growing niche, which is that kids niche, and this is not an area that AppLovin will be entering because they've actually stated that they have no interest in the Copa type of business. And Kidoz is trading at a far lower premium, as you would expect from someone up against a global giant. Our financials, here is a look at the year over year. So we are a profitable company, but we have a large amount of seasonality. And so it is better to look at the company year over year than it is at the quarterly level, because fluctuations come in, particularly in Qs 1 and 2, because depending on how the deal flow arrives from our core partners, it can impact, because our costs are obviously less variable because the largest component of our cost is our people. And so when we see the revenue fall like this, a huge amount of the profit is coming in Q4. And so really the best way to look at the company is either to compare Q4 versus Q4 or year versus year. Of course, there's interest in the quarterlies, and we're always thinking of that and looking at it. But given the strong seasonality, it's best to look year over year. And we can see that we've had an excellent Q4 2025. The final numbers aren't in, but it's been a great year and many happy brands. And myself as CEO, I'm thrilled with the results and the capabilities of the system. And while I'm celebrating, I'm also conscious that there are things that could have been better, and we're working to improve those things. And we can talk about them in a little bit. One, this is a look at actually 2024, because we don't have the numbers yet from 2025, but we can see that we're in a strong cash position. We have no debt. We had a small amount of profit for the year, strong gross margins, and the revenue projection up considerably, 28% growth. I think it is 14 to 18 million year over year, and increased profitability. And we're working to really harness the leverage that we can see in the company. But one of the key components is our R&D, and our R&D is something that we're constantly working on. We've had to fund this from the company's revenues each year, of course, and it is fully expensed, all of our R&D. So there's no big drag of depreciation. We have not capitalized our R&D expense. One thing that happened in 2025, because we are seeing growth in the R&D larger than we would have liked, is that we knew we had a very large pipeline of deals coming, and we were advancing our system. And so we had to run some components, both a new component and an old component, in parallel for the second half of the year, which resulted in some one-off R&D costs because we had higher infrastructure costs than we would have liked. But we made a conscious decision to do that to ensure that we would capture the full pipeline of sales, which we did. And so now we're, celebrating that we grew so much, but we're also now looking at how we can maintain and scale our infrastructure without as high costs. So that is now one of the missions of our technology team. And in addition, what this slide is doing is it's showing kind of a few things. It's showing that the best way to think about R&D is that there are two components. There's the maintenance R&D, which we need to do on the existing system to optimize it, to keep it running. Yes, some feature development to keep pace and reduce errors. But there's also a growth spend which is coming in, because ultimately we're a company about innovation. And without innovation, the brands or customers will move on or find someone else or something else that they're excited about. To keep people engaged, you need to innovate. And that is why most software companies will have consistent R&D, and we are no different. And for us to reach that 100 million plus revenue target that I'm after, it will require innovation. And so that's why we're trying to look at this. And I know that many investors are curious about how R&D spend will trend. And basically, our answer is that we want and will decline as a percentage of revenue as we grow. And we will continue to analyze our R&D and share more with the investor community after our 2025 numbers are fully out. And we've had more time to digest where the costs were and what we can expect going forward. But we're on top of it. We've had a great year, and you can definitely trust that each dollar that we're spending is spent on purpose and with design, and is either maintenance or growth. This is a slide that shows the breakout in 2024. You can see that we are a very global organization. We had more revenue from Western Europe. And actually in 2025, you're going to see this balance more to North America, because the US, our investments in North America have been paying off very nicely. And I think North America will be a higher percentage than Western Europe. Internally, this is the executive team. Myself, obviously being CEO, Eldad is our president in Israel. Tarni is based in, TJ is in Vancouver, running our technology, 20 years plus at Electronic Arts. And Henry, our CFO, is in Vancouver as well. Stacy is based out of Toronto, running our sales and marketing, which is another growing org. And here is our board, a number of different jurisdictions. For these folk are our non-executive board, and they've been with us for many years. Kidoz is a fully remote organization. We're the technology is heavy in Vancouver, Canada, and sales and marketing is distributed, operations is distributed, and that has been serving us very well. This is a new slide to show the current and recent stock performance. What I really wanted to highlight is we've had some investor questions about the fact that we have a market maker, a Canadian market maker, that we pay, I think it is 7,500 Canadian, so less than $5,000 a month. And there have been questions about that expense and what value it brings and et cetera. But this chart actually shows exactly that value. And so ITG is our market maker. They were brought on here, right in the middle of this chart, at the beginning of August. And you can see prior to August, the wide spreads, the jumping, the lower volume, classic illiquidity. Whereas post-employment of ITG, sorry, we can see much tighter spreads and volume increasing. And this is where we knew that we were turning the corner strongly. We brought on our head of capital markets, and we began our attendance at Planet Microcap was in October, and we'll be attending more events in 2026 than ever before as we continue to meet and discuss and tell the story about Kidoz. And we're very grateful for everyone who is looking and following us on their ticker. But please, from this type of chart, and I welcome all questions, but this is a very small amount of money to give us stability and a platform for growth in the market. Here is our capitalization. So we're currently sitting at 34 million US, 26, and it's obviously relatively higher for the Canadian listing, 131 million shares outstanding. And we've got a good split. There's lots of ownership with our directors and officers, myself, and the other leadership team. And I think really we're very well positioned as if the company can continue to execute for this to grow and for you to see returns over the long term. Thank you very much.
Thank you so much, Jason. Guys that are listening, if you got a question to ask the team here, please use the chat function and we'll get that done. You've gone through call it a refresh or revitalization of the business as you discussed.
Yeah.
Going forward, what sort of the greatest challenges you're facing as a business? What's happening within the industry that might be doing that? But just generally, what sort of keeps you up at night?
It's a good question. I mean, honestly, the biggest challenge in the business is those agencies and brands' decision-making process. And so, it takes a considerable amount of time to engage with them, build their trust, and then get onto a plan in a meaningful way. And in a large part, that is what is, why we haven't spoken in several years, because we've been building up our US sales team and establishing that trust with enough brands to start to show meaningful growth. And we've crossed that chasm at this point, and now we're starting to hit stride. And really, it's about making sure that each of those brands that is within the high trust and high spend category continues to be high trust and high spend, and that we can bring in many more. And so that is the biggest challenge of the business, is taking from, call it 3 or 4 core brands to 10 or 20. So that is our big challenge over the next 1 to 3 years.
Now, I think I saw $2.8 million. I think you said you've got in cash right now.
2.8.
2.8. Yeah, that's right.
Yeah.
Is that enough for what you need to do? Do you have growth initiatives that would require more? What do you think of the balance sheet?
Yeah, no, good question. And that was actually the end of 2024. So in the end of 2025, I don't have that figure, but it should be a bit higher. So actually, we've been really lucky and fortunate and pleased with our capability of cash flow management. And sometimes if you're too dependent on 1 or 2 clients, the cash flow can be an issue. But we've got some great relationships, and they're very fast payers. And so we've got enough cash for all of the initiatives that we're on, because we're sitting, I haven't seen the numbers obviously, but over 3 million in cash would be my guess. And that's more than enough for everything that we need. We have no intention of going to the market. We don't need more for growth. So we're not looking for cash.
You need good. Okay, I mean, the last quarter was a tremendous growth quarter for you guys. can that pace can you expect to continue that pace, or is that sort of a bit of a one-off and things plateau a little bit? How can you describe the
Well,
potential?
I think if I remember correctly, it was something like 60% year over year. And so, definitely our target is 30% year over year
Mhm,
for the whole company. So that's what
mhm,
we're hoping to do. The 60% I think was, of course, an exceptional
mhm,
quarter. But I think some of what I said before in that like Q1 to 3 really some of the way that the campaigns land year over year can benefit one or hurt the other. And so
mhm,
2024 Q3, I think, was a bit soft, whereas 2025 Q3 was a bit strong. So that's why you saw the 60%. But really,
mhm,
if we look year over year, if we're seeing that 30% growth, then I feel like we're winning and we're achieving our goals. And so
mhm,
that was our goal for this year, and that has been achieved.
mhm.
I would just like to
Yep,
add
go
if
for it.
I could, the overall trend in kids digital advertising right now, by
Mhm,
third party research is 8.5 billion for just kids advertising. It's projected to have a 25% CAGR over the next 5 years.
mhm,
So it's somewhere around, I think off the top of my head, like 28 billion.
mhm,
So we're definitely seeing that shift, and especially with all the regulations that's happening
mhm.
with social media bans that
True.
already
Yeah.
happen in Australia, and there's definitely a domino effect going across Europe this year. So they're all going to be
Mhm.
tailwinds. So we're expecting some sizable growth from it for sure.
Yeah,
Yeah.
you sort of segued into my next question, just that, like the
Oh,
trends
perfect.
within the industry, it sounds like they're all going sort of in your favor, tightening regulations, things like that. Um, like, is there more adjusting you have to do to sort of meet these trends, or you pretty
Not at
confident you're
all.
sort of
No,
you're
yeah. I
spot
mean,
on?
and thank you, Ryan, for bringing that up. The social media trends are exceptionally helpful for us because actually I don't know if they're a competitor, but they're a substitute, which is YouTube. So someone who is buying to reach kids is buying games and they're buying YouTube. And so, when YouTube, each time that they get lumped into social media bans and,
Mhm,
that creates either a full block from users or it creates fear, which is actually fully justified in parents' minds, and
mhm,
then they use it less. And so then you're going to see more reallocation towards games, which helps us, and that is what we're seeing. So,
mhm,
I think it's a welcome and deserved trend and regulatory. If the tech giants aren't going to take the responsibility, it's nice to
mhm,
see the regulators doing the right thing, which is reducing access,
mhm,
and that benefits kiddos. And to answer your question, there's nothing that needs to be done for us. We're built from the first line of code completely data clean, and
mhm,
so there is zero changes that need to be made. We're constantly keeping pace with everything that is there, but when you have no data within your system, you don't have to worry about making a data infraction or having to change the way your code works, unlike
mhm,
many, many other companies.
mhm. Gotcha. Now, earlier you did talk about competition. I want to revisit that a little bit,
Of course.
just to get a sense of like where do you position within the competitive landscape? Are there bigger players, smaller players, and ultimately, sort of what happens to your business? Are you a buyer, or is there acquisitions within the space, or do you just expect to grow organically?
Yeah, good question. So competitively, historically, we usually go up more against like say agency groups. So if
Mhm,
they're like say McDonald's agency is selling a campaign for Happy Meal, they would put out an RFP for requests, and we would bid into that. And historically, and still today, we compete more against groups that are not technology companies.
mhm,
Most of them are sales agency type
mhm,
groups that then work partner with other groups, which is why their costs are higher. And it's a little bit of an older model too. It's a model that depends on expensive lunches and
mhm,
taking the agency teams out. Whereas our focus is on hey, it's about the technology, it's about the creative, and look, we can deliver this incredible price to you, and we're nice to work with as well. So you kind of get the full gamut for a lower price. And that helps us win. And actually, there used to be a competitor that had the beginnings of this technology. And back in the day, we would compete head to head on a technology level, but they've actually retired their technology because it got too complicated. The returns weren't there for them. And so they've focused more on YouTube and influencers and other things. And great company, good for them. But it's a bit like when you're building deep technology, it's like building a card house. But if your foundation isn't really, really strong, at some point it's going to start to fall over. But the quality of our engineering is far and beyond what most startups or any kind of small company would have. And so we have built an exceptional foundation that is handling billions of transactions every single day. And we've actually, as I didn't even mention it, but the reason for that one-off cost is that we rebuilt the entire analytics system for this company. And this is an insanely complicated piece of technology. And we ran the old system and the new system in parallel for about 6 months. And that helped. That was increased cost. But now we've retired the old system. We're on this new, fully modern, fully scalable system. And it's flying, and we're ready for more.
And ultimately, what happens to your business? As I mentioned earlier, are you the buyer, or do you get bought in this industry? What happens?
I think, I mean, certainly, we're not looking to get bought. It is not our vision to get bought. One never knows who's going to come out of the woodworks. But and I'm not interested in buying at this price. But if the stock continues to move, then there are options for us to buy that we feel are good synergies and will help to speed our growth. Then there's nothing that would really stop us besides protecting our own shareholder base, which we're active participants in.
Yeah, fantastic. And then, so the last question for me for now is just again looking forward. You guys, your cash is going to build up. What do you do with cash as it builds up? It sounds like your R&D spend is going to, at the very least, flatline in comparison to your revenue. But that means your cash builds up. And what do you do with cash?
Sure. Yeah, I think that we've got growth on the sales team, certainly that we could chew off more of. As the innovation continues to go, there will be opportunities for more. But if everything goes according to plan, you're correct. The cash balance will increase, and then we can look both at it gives us more ammunition at a bargaining table for acquisition because they can reduce the share component and of course sweeten deals if people are looking to exit with some cash in hand. So it could be used for that. We could look at share buyback as opportunities. Once we get, I say we're comfortable with cash now, but of course CEOs always want more cash, and I would love more cash because then you can do more things. And so once we get maybe across 10 million, then we'll have to talk again, and I'll tell you what our current plans are for the cash. But right now it's used for operation.
You got it.
I would jump in to address just a couple of points. So you're going back to one of the biggest challenges from my standpoint, I would say, is definitely increasing Prado across the US. And what this kind of question you're asking now leads into that is basically, I'd say we're a very frugal company and very wise with how we spend. And we spend very strategically and very targeted. So I imagine we would use that cash, like Jason said, across sales, but also in various ways to help get campaigns, get on more radars, attend more events, these kinds of things.
Yeah, marketing. You got it. Okay, well, let's jump on some questions that have come in from the audience. I'm going to start with Paolo. He asks, how's the overall ad environment right now?
The ad environment is very healthy. America is in a growth run right now, and there was some hiccups with a lot of the tariff wars last year, but we don't see any slowdown from any of our clients in terms of hesitation to spend. People actually know, if anything, it's bullish on ad spend right now because it's either spend or shrink. So that's what we're hearing from the market.
And I imagine your business, like so many other ad businesses, you're seasonal. Obviously, the Christmas sort of season must be heavier for you guys. Is that the case?
Yeah, absolutely. And in particular, because we have the kids business. And so the kids business is very focused around Thanksgiving and Christmas. And so both those fall in Q4. And so, as one of our goals is to flatten that and hopefully, as we see more success with Prado and some of our investments there and partnerships there continue to pay off, we'll see it flatten. But I expect 26 to be the same.
Well, I would just add to that, basically, it feels like we're being more known as kind of the hard to reach guys, not that like we're hard to get in touch with, but we have expertise in hard to reach audiences. So reaching kids is very difficult. It's a very big risk. And once you can deliver on that, you're in forever, right? Like even our biggest advertisers, there's a lot of room to grow. We're just at the tip of the iceberg there in terms of their spend and what they're shifting over. And then with the Hispanic market, it's very, very difficult to reach this market in a way that's effective and cost effective. And like we're very close to getting another 2 Fortune 50 companies to start working with us in that aspect as well. So very, very positive signs, and it's a very good niche to be in, to be known as, like, because we all care about privacy, right? As users, and the agencies care about privacy. Everyone cares about privacy. So when you can approach the market being known as like the guys that can scale, they can deliver quickly. When agencies are fantastically known for being let's say it for a spade, they're pains in the asses, right? And so if you can deliver on that, I need this in 2 hours, and we do it, wherever it is around the world, they cling to that like it's dear life. And so that's what we're seeing. And if you put these things together, being known as the hard to reach guys, the guys that deliver, and the guys that, have quality, that's a really good recipe for future growth.
Yeah. No, fantastic. Okay, next question. You sort of maybe have already answered it, but Apollo asks, is there an appetite to buy your own shares back? Do you guys have an NCIB? I don't think you have an NCIB in place right now, do you?
We did one. I forget if it was 23 or 24. I think it was 23. And we didn't see a good kind of return on that. But it's not something that we've written off by any means. Like I said, we'll continue to entertain the best way for us to place our cash. And currently that is holding it and using it for growth.
For marketing, yeah. Gotcha. Okay, next question comes in from Shai. He says, for what reason did the company choose to go public, and do those reasons in 2026 still remain valid?
Right. I mean, this entity, we've actually been shepherding this entity for more than 20 years. And so we got here with a story that would take another call. But, I suppose the situation is the fact that you make the best of what you've got and you turn it into an advantage rather than a disadvantage. And so, we could make a long list of why we're too small to be in a public company, but the reality is that that's a great challenge, and we're going to use the advantages of it, like engaging all of these great people to get excited about the story and move the stock up to where it becomes a strategic advantage for what we're doing. And it will become a strategic advantage when the share price gets higher and the company continues to grow. And we can look at those acquisition opportunities to take this up to and past 100 million in revenue, and then everyone who invested at this level will certainly be happy that we weren't a private company that they had no opportunity to know about.
Yeah, fair comment.
Yeah.
Yeah.
Well
Yeah.
said.
Okay, next question comes from Joampi, who says, why should a large app developer or brand choose Kidoz over competition? And what specifically would prevent them from switching away? Maybe what's your secret sauce? What makes you better than somebody else?
Sure. So app developers choose monetization systems based on their capacity to monetize and the trust from said group. And they don't use one, they use multiple systems at one time. And so someone chooses Kidoz because they know that they have kids in their audience and they want to be regulatory compliant. There's actually not very many ways to be regulatory compliant and monetize other than using Kidoz. So actually, we're in a very strong position as these regulations continue to move. And actually, we haven't even touched on the idea of like the app environment is actually mostly not age gated. So when you go into an app, you don't see an age gate. And so actually what a huge percentage of app developers are doing currently is they force you to agree that you're not a child. And this is not a very good tactic and is actually outlawed in some ways by the app stores themselves. They say, if your app appeals to children, then you should use an age gate, but they don't enforce that rule because it would require a whole bunch of like time and energy that they don't want to invest. And so should that ever come into force, and the way the regulations are going, it would be an enormous boon for Kidoz because we would gain an enormous amount of new traffic on our system. And so actually, without even talking about it, that there's a huge opportunity here if the continuation of these regulatory trends go. And to answer the second part of the question, would they trade off of the system? Yes, it's possible. And of course, we've had apps that have moved away from the Kidoz system, but net, we always see more. We're always growing. And we've developed our technology is not totally dependent on the partners that have installed the SDK level of our technology. We run campaigns, compliant campaigns, because we knew that we always need more capacity to grow. And so while our technology sits in several thousand apps, we access more than 100,000.
Gotcha.
I can take a different turn if there's a minute. So first of all, on Jason's point, I mean, a real blunt and humorous way to say it is we've tried working with data and we sucked at it. So I mean, we can't do data if we tried. So it's like we're so good at the contextual, we don't really need it. But I'd really like to point out the more tangible and human side of this. And I know every company says this, but I really think for us, what stands out is our people. Listen, at the end of the day, the technology you make and the people that serve it and the people that sell it and market it, they're all people. And so if you have really talented people, you stand out. Um, I'm sure every company in the world says this, but there's a couple examples I always, when I'm in investor calls, I bring these up. Like one, I've been here for 7 or 8 years. I was the first employee when we merged. And in my time, I've seen out of 65 people, 4 or 5 have left. So I've worked in a lot of companies. I've never seen that in my life. The second example is, sometimes we get the question, well, what did you guys do in Corona? How'd you get through Corona? I guess that's somewhat of an indicator. What we did in order not to let anyone get fired is this guy here in your screen and a bunch of the other leaders took huge pay cuts so no one else would have to suffer. I don't know a company that does that, man. Like I said, I've been in companies. That's what the kind of stuff that separates you. And we have, girlfriends that come in, we have wives and husbands that come in. And once you come into Kidoz, man, you don't leave. You don't want to leave. I can't wait to get up every day. And I think 65 other people share the same path. I think we're really pumped for the future.
That's fantastic to hear.
That's
Okay, another question from Shai. Shai asked this time, he says, there appears to be a notable emphasis on the company's share price as reflected in expenditures on market-making services and participation in self-promotion events. I'm trying to understand how management views the relevance of the 2026 share price to the company's 3 to 5 year strategic outlook. Specifically, is the focus driven by potential M&A in which the equity serves as acquisition currency?
Sure. Okay. I think there's a few questions there. I think number one, yes, I specifically that slide was in the deck to talk about the market making. And actually, if we talk about the full expenses of this company, we're up in the kind of 7 million US range, and the total amount spent on market making is less than 60,000 US. So we're talking about less than 1% of our total expenses is handling our listing. And we can see it is night and day from before we started spending that money until after we spent that money. So 1% to give us a stable market is some of the best money that this company has ever spent, and is giving confidence that you can buy and sell at any time. And that is one of the key requirements of public company investing. So in my opinion, it's great money spent. I'm happy to continue to engage on that. In terms of 3 to 5 year, I'm not sure exactly what that was about. Was that about the promotion?
I think he's basically really asking, like, and do you see M&A opportunities? And that's why currency matters, right? Obviously, higher share prices you mentioned earlier would incentivize you to go and get more aggressive.
Yeah. No, I mean, we are excited to run and build this business in the best way possible for ourselves as shareholders, but also me as a technology CEO that wants to grow. Like my focus is growth, and that's growth of the share price, and that's growth of the revenues, and that's growth of our profits, and that's growth of the overall happiness, which Ryan was just talking about, amongst all of our employees. And that is achieved through hard work and striking at opportunities. And right now, our share price is too low for me to entertain acquisition because it would dilute me and all of you too much. And so, but there is a point, yes, where that risk reward becomes in our favor. And yes, we would absolutely use the currency of the equity to make a strategic acquisition when the price meets my criteria of we're going to get more value and higher growth from the amount of dilution that we would have to swallow. And today there are a couple of interesting, great partners out there. Maybe it's an agency partner that has a great sales traction. Maybe it's a technology partner that has some cool inventory. And I continue to keep those groups close because that's what I do anyway with partners. But at the same time, at the back of my mind, maybe there's an opportunity down the road, but it's not today. But yes, absolutely, that's an option.
You kind of answered my question. What sort of companies are you looking for? So you're looking for possibly an agency that could help with sales, or some technology that might fit in with what you do.
The key criteria for me is like, of course, it has to accelerate our growth. But I'm also looking for good culture fits because we have a unique culture of hard work, innovation, and friendliness at the company. And that's if you don't fit that box, then we don't want you in the first place. And then it's going to be sales is critical because sales drives growth. And so and relationships are critical for sales in brand world. And so there are groups out there that fit those criteria that I'm aware of. And also on the technology side is actually harder to find good fits because there's a lot of bad technology that's built, even though it pretends to be successful. And so you have to find people that are very rigorous in the kind of structure of their technology. And I'm aware of at least one, actually only one that I'm excited about, but we're going to have to wait for the share price to get higher to learn the name of that one.
It's like the investors, the investors do all the research and the deep digging research to find, the perfect fit. And it's exactly like that in technology, and perhaps even harder.
Yeah, no doubt. Okay, question from Yuampi who says, what percent of your revenue is recurring year over year? And do customers typically stay or leave? Talk about that. Like, what does a typical contract look like? I imagine
Right.
there's programs and there's probably something more substantial than that.
Yeah, actually like yes, they recur, but
Mm,
no, they're not under contract. Most campaigns are 30 to 90 days, with
mm,
the average being 40-ish, maybe
mm,
even closer to 30. And so, but the way that it works is with these partners is that, like, one of the most common terms we hear is trusted partners. And
mm,
there's not very many trusted partners. And so once you get to the trusted partner level, then you start to get a high share. And say maybe there's five trusted partners. And so then the key is actually maintaining yourself at the trusted partner level, because other people will fall off because they'll make mistakes or they'll have turnover, and then a new person makes a mistake. And so back to Ryan's point, that retention becomes very, very critical to maintaining yourself as a trusted partner. So once you're in, and then the longer you're a trusted partner, the more allocation you get. And
mm,
so because you have built more trust and you've invested in innovation, so each year you're not only gaining trust and doing the same, but you're saying, hey, look, we should try some of this, you should try some of that.
yeah.
And they start to trust that you can execute for them and that you're not wasting their money. And
Mm,
and again, like our because we've got a cost advantage, because we're both creating the relationship and building the technology, then they're getting value as well. So
mm,
we're ticking a lot of boxes and on that trusted partner level. And to answer the first part of the question, almost all of the revenues that you're seeing are from, like, they were repeated from the year before. I'm just thinking in my mind, like, what percentage. Obviously, there are going to be new brands coming on all the
mm,
time, but because most brands you've worked with from the previous year, it's almost all repeated. It's just some
mm.
are growing their share significantly. Of course,
Right.
there are new deals, but they start small. Usually they're starting in the 10 to 50,000 range. And then over the years, you grow them to the millions. And
Mm,
that is where we're at. And but you do see some start higher,
mm,
and then they grow potentially more quicker. But
mm,
there's a huge amount of repeat business. It's almost all repeat business. And
mm.
so now it's about bringing on new initial spends to grow to that large repeat business.
Mhm.
Yeah,
And I can't
that's
remember. Oh, go
primarily,
ahead.
sorry, that's I was just going to say that's
Yeah,
primarily on the Kiddo side. On the Prado side, it's blue ocean. I mean, it's there's so many brands in so many directions. There's
yeah,
3 billion users of social media, 3 billion users of like YouTube type
sure.
video platforms. There's 3 billion gamers, but only 4 to 5% of brands are spending digital money, like digital
Hmm.
advertising in games for brands.
Hmm.
So it's so blue ocean. We
Yeah.
just need to attack it, really.
Mm. Gotcha. Um, um, again, I can't remember if you said this or not, but how much of your revenue is performance based? Like,
Almost
um,
zero.
almost zero.
It,
Okay, so it's
yeah.
all sort of
It's
budgeted.
all, yeah, it's
Yeah,
budgeted awareness
yeah,
campaign. And so they're building brand awareness is the key goal that they're doing
yeah.
within target segments. And so the
Right.
fact that we can target within unique segments satisfies their, are you reaching the right person? And
Mm,
then the fact that our media is very performant in that it's engaging and people watch the full video satisfies the, okay, I'm reaching the right person and this media is more performant than
mm.
XYZ other media that is on plan. So I should therefore increase the allocation.
Right. Right.
We love that. We love you guys moments. We love you guys moments. When
Yeah.
we hear those,
Yeah.
we our ears perk up and we write them down. We love you guys because of this. We love you guys
Yeah.
and it's usually
Yeah.
the smallest things. That's the ironic part.
Interesting.
Yeah.
Well, it
Yeah.
seems
Yeah.
like in marketing, it's the little things. It doesn't. I mean, so much
That's
is
right.
similar amongst your competitors, I'm sure, but it's got to be that last little mile that
Yeah,
less different
That's
than most
it's
100%.
what
different.
brings it all together. It's funny because like we actually talk about like, should we have a slide in the deck about service? Because actually
Mm,
our service is what takes it to the next level. But sometimes
mm,
people just assume, well, service you
Yeah.
get, right? And so
right.
we don't usually put it in. So you have to
Mm,
work with someone to understand the difference of the level of service that we give. And that actually, one of the key standouts for the group is the creative department. And our creative department, because we actually come from a game developer history, we have deep knowledge and understanding of what it takes to build great creative. And
mhm,
that is something that almost no other groups, even agency groups, have because they weren't game developers before.
mhm,
But essentially, what we're building are game level creative ads. And the brands, like it's, you can fake a lot of things in marketing, but you cannot fake quality creative game development in
mhm,
partnership with a brand because you make mistakes if you don't know what you're doing. And but we
mhm,
don't make those mistakes, and we repeat it again and again and again, which is why we've been a
mhm,
partner of McDonald's for many years.
mhm,
And we're very proud of that capability and of the trust that we've built with them.
mhm. Is there any customer concentration with your business? What sort of
Yes,
what does the
yes,
top
yes.
customers look like? Yeah.
The top three are probably 60% of the business. And
Mhm,
so that is one of the risks of
mhm,
the business, and I'm aware of that. And it's something that we're working hard to create a fourth and a fifth.
mhm,
But at the same time, those three have been with us for years and are growing. And we remain firmly in the trusted box.
mhm. And how much, like the difference between agencies, I'm sure you work with agencies and then you work directly with some of the brands. Is there a
Sure.
breakdown of percentage in terms of what that looks like?
It's more from agency because the bigger a brand, the more hands off they are on the
Right,
actual spend. And
right.
so there are certain trends in the industry that are where brands are taking away budget and power and they're
Mhm,
in-housing. And so we can fit in either scenario, and we do
mhm,
fit in those scenarios. So I don't want to talk specifics, but we do work under both scenarios with key clients. And in some ways, having less conversations at the table is better, but in other ways, having the kind of rigor and professionalism of the agency is also super helpful because then you just know what's coming, and there's
mhm,
there's less knee jerk.
mhm. Yeah,
So it's
gotcha.
win on both sides, and we're participating in both
On both
manners.
sides,
But
yeah.
it's more traditional for the big brands. The bigger a brand gets, the more they outsource their
Okay.
marketing.
Yeah, that makes sense. Guys, looking forward, what gets you the most excited about 2026?
What's exciting about 2026 is the fact that we've achieved so much. And the amount of excitement internally for us is that we're actually just scheduling an offsite with a bunch of leaders in the company. And we're bringing together a bunch of commercial leadership and engineering leadership with the philosophy of like, we understand the people who are doing the selling and the people who are doing the building, to understand what it is, what are the greatest things that we can build this year and next to really continue this growth and even accelerate it. And so I would say what's exciting is the fact that we've had the success, the system, like the trees are growing, the forest is there, and now we're going to shepherd them into great oaks. And so the fact that we've worked this hard for this long and have seen the success and know what that feels like, and be able to kind of um, say that in a room of buyers is the
Mhm.
most exciting part of being a CEO. And I know that the rest of the team feels that as well. Like there's just an incredible excitement internally for what we've built and the capabilities that we have. And the brands feel that too.
Mhm.
So we're just
Mhm.
excited to
Can I
keep
get a
going.
crack at that question as well?
Yeah, go
Absolutely.
please.
Yeah, so I mean, for me, like we were talking just before we recorded, Paul, I was making cold calls a minute up to like when we started the meeting. And you can't do that unless you're super motivated, right? Like every minute I feel, and I think my teams feel, our teams feel like we have some technology and people that can really help a lot of problems on the advertiser side, on the kids' privacy side. We're doing a lot of good in the space. I mean, I forget the term, like the environmental. We're eliminating steps in the chain, so it's more environmental friendly. It's social
Mhm.
positive. It's governmental positive. Um, and we've just seen a lot of firsthand evidence that this is working for
Mm.
advertisers. It's making their jobs and their lives easier. So when you see that, you get really pumped. And I think we're just going to bring this to more scale, more people we're going to help with the tools we have and the talents we have. And that gets me
Mhm.
very excited.
Right on. Right on.
100%.
Well, okay, so we're investors. We just heard the story here. Now, 2026, what do you think are the catalysts or potential catalysts, or maybe even metrics that we should pay the most attention to?
I think what I'd like you to pay the most attention to is the 2025 year-end results. Like, look at that full year, pick it apart. Let's come back together, ask us all the questions, let's get them ahead of time, let us prepare. And, we would love your feedback on what you felt was good and what you felt was bad, because it was a great year. And like I said, I know that we can improve some of the cost side and in the way that we were running our infrastructure. And that's why we highlighted those one-off costs. But as we grow, we're really leaning into the fact that we know that we can demonstrate operational leverage. And, we're going to ask for patience through Q1, Q2, and Q3. I hope to surprise to the upside on one or two, or hopefully even three of those. But at the same time, this is a year-over-year business, and it's going to take some year-over-year analysis rather than the quarter-over-quarter. And
Mhm.
so, but in terms of other things to look out for, we're definitely come and meet us at some of the events, follow
Exactly.
the releases, and we hope to be putting up some great numbers throughout the year. But
Mhm.
the system is built and the staff is here, and we're very motivated to bring great results.
Awesome.
Yeah.
And
And
then,
I would
yeah,
just add, sorry, Paul,
no,
like
go
first
for
of
it.
all, big fan of small cap discoveries. And I love the work you guys do.
Thank you.
And I personally have been more on the business side, but now I'm on the investor side. So I personally am an investor, but I'm learning kind of the micro cap world as Phil is as well. So we're really stoked to just meet new people, and we're having a lot of great conversations. And like Jason said, come talk to us. We're very friendly guys. We love learning about, like, we're reading the Substacks, we're reading the micro cap club stuff, we're listening to the podcast. So, reach out to us. We're happy to talk stocks, happy to talk kiddos. We just, want to be more involved with everybody and all the great work they're doing.
Yeah, well, we got a lot of guys that love to talk stocks, so be careful what you wish for
Let's
here.
do it. Let's do it. I'm all for it.
Sounds
Let's
good.
do it.
Awesome. Well, listen, last thing, it's sort of open-ended question. Is there anything we missed, or is there any key message you want to make sure everybody walks away with today?
I mean, nothing is coming to mind besides, stay tuned for the 2025 results. And we're very proud of what we've achieved. And I think actually one thing I will give, and this is my philosophy when it comes to software and why I love software. And that has to do with the idea that when you build a piece of software and it starts to make money, your goal as a leader is to make enough money plus a bit to pay for everybody that's making that black box, because you can make it better, and it will open and it will make more money the next year. And as long as you continue with that philosophy, you're getting bigger and better, and you start to get to doors that when you open, there will be a huge amount of money behind. And that is what we're building, and that is what we're executing, and that is what we've done for the last 6 years. And it took us the last 3 to change that sales strategy because the box was pointed in the wrong direction. But we pointed it in the right direction now, and we're running really beautifully. And the sky's the limit.
Fantastic. Jason, Ryan, thanks for joining us today, and congratulations on a very, very strong quarter, record quarter, by the way. Look forward to the next time we can catch up. So I really appreciate your time today.
Thank you, Paul. Thank you, Trevor. Thanks to the whole team and for everyone to come in.
You got it.
Great to be here.
Thanks. We've been speaking with Jason Williams and Ryan Lexer, Kidoz Incorporated, KDOZ or Z on the Venture Exchange. One last time, thanks, guys.
Thank you.
Thank you.
Have a great evening.
You got it. Bye for now.
Bye.